We share the vision with our team as we take on a new property and on an ongoing basis 3 times a year. We bring all the teams together and we share our vision. We talk about how the resident is number one, closely followed by our investors. Our team knows. They know that our investors rely on their work, their good work, to deliver results.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I am here with Arleen Garza. As the founder of REEP Equity, Arleen Garza serves as a primary decision maker on acquisitions and company growth strategy. In 2017, she co-founded a real estate management company that currently manages properties in San Antonio, Houston, and Austin. So, Arleen, there's a ton of really interesting stuff in your bio, but as I mentioned, I really like to let people tell their story. But first, I'll just say thank you for being on the show today. Thanks for taking out the time and joining me. I'm very excited to talk today.
Well, great to be with you, Jason. I always enjoy these opportunities because it allows me to hopefully share something that will help somebody else down the road. I know we've received a lot of help from others in our investing and real estate journey. So anytime we can help, we're happy to do that.
Yeah.
So a little bit about me. So I grew up in a small town in West Texas. Uh, Decided to pursue a degree in finance after watching, working class parents really work very, very hard. They were great at saving, but they weren't. I think the missing piece for many of us and families is how do you grow the dollars once you've saved them? And so I became very interested in finance and in a degree in finance for that reason and went into banking. So I spent 20 years in the banking industry as a lender and managing banking centers, which is where I had a real opportunity to work with the Hispanic community in on a radio show where I really talked
Oh,
about
cool.
budgeting and saving and how to establish good credit and maintain good credit. And then once you've done that, how do you grow your dollars? And so it's been a passion of mine to educate in anything that I do. And so at REAP, one of the things that we do is we provide a lot of content on our website to help investors, potential or existing investors, really find a way to grow their wealth for whatever impact they want to make with those dollars.
Yeah, that's great. I mean, radio shows were podcasts before podcasts were
Yeah.
a popular thing. So I think that's. I mean, yeah. I mean, dating myself a little bit, but it's that was what it was. You listen to radio shows, and then I feel podcasts have only been really popular for maybe 5 years, a little bit longer than that. But before
Mhm.
it was done. Same concept here. What we're trying to do on these podcasts is provide some uh, education and knowledge for people that can to take advantage and help grow their wealth. So, um, working in the finance world and sort of helping people learn about financial literacy and how to grow their wealth. I mean, where did you start with that? I mean, when you were doing the radio show, now with REAP, what's your focus? Are you mainly real estate focused? Are you sort of asset class agnostic? How do you suggest people build that portfolio?
Great. Good question. Yeah, so we started building that portfolio with a 24 unit property that we bought here in San Antonio. So we were in Dallas before. My husband had a property management software company. So he had seen the back end of what owners were doing, that he had almost 20,000 users of his software at the time managing their properties, all multifamily. And he had an opportunity to exit that business in 2007. Now, 1 year before that great financial crisis, we were blessed with
It's
the
good
timing,
timing.
I will just
Yeah.
say, yeah. And
Yeah.
so then after he sold, he said, I'd asked if we could move to San Antonio for family reasons. My mom was here, is here still, and siblings. And I like the culture. I wanted our kids to grow up in this environment. Not that there's anything wrong with Dallas. Dallas is great, but being around family, being around, some of the cultural elements of the what San Antonio offers was important. So we moved here, spent a few years educating ourselves on because he wanted to buy multifamily right away. And I said, "Oh, I need to understand the numbers to be comfortable." And I think a lot of investors feel the same way. So we started with the 24 unit, which we purposely ran ourselves. We wanted to understand, how does a property work? What is important? And how do you make it successful? So fast forward a couple of years from that, we sold that property at a 370% return. Now, not every property has sold at a 370% return of the 11 that we've sold, but they've all done well. And so for us, it initially was okay. The financial goals were key. And now fast forward to today, we've purchased 34 multifamily properties in Texas, San Antonio, Houston, and Austin. And I think what's happened, I know, not I think, but I know what's happened is those financial goals morphed into, how can we make an impact? How can we do good with the work we're doing? And so I think that's really where it became more of, how does it fit with our personal values and, our life's purpose? So what we've found is that we have, call it 15,000 families that live with us at our properties. So how do we make an impact with those families? We provide them a clean, nice place to live. We create community through community events, through back to school drives, through um, food drives, you name it, so that what we're doing is creating better communities than we found to begin with. It was important to empower these families that live at our properties, but also key was to empower our team. We have almost 200 people on our team, and so we're impacting almost 200 families there. So, we wanted to make sure that we were impacting them in the right way. Some of those, team members invest also. So we wanted to provide them an opportunity to grow their money on the assets that they run, that they, focus on day in and day out. And so that was key. And then our two kids. So we have young adult kids. Our daughter is 30, our son is 27. And they grew up in this industry. When we bought our first property, they were there with us on Friday evenings, passing out cookies and pizza to the residents. And so they learned quickly about the value of resident relations, taking care of the ultimate end user, the resident that pays the bills, pays the mortgage, creates those opportunities for us and our investors to do well on the financial side of managing these properties. So lots of different reasons that have kind of morphed out of the original idea, which is, hey, this is a great market to invest in. Apartments are a great thing to invest in because people always need a place to live. But then it became, how do we make it the best place that we can make it for these families?
Yeah, I really love how you tied all of that together and kind of the level of impact that goes. I mean, frankly, that can there's going to be impact, and it can be good or it can be bad, right? Because you are providing housing. So however many number of units you have, you're providing housing for those families. You have employees. They have families to support. So the impact goes a long way, and kind of recognizing and focusing on how that all ties together, I think is um, a really fantastic, I guess, lens to look at it through. Like, yes, it's investing in it, and I mean, and lump the investors in there too. You've got people that are trusting you and investing with you. They've got families, and so I mean, ultimately, at the end of the day, when you talk about real estate investors, and specifically, really in the syndication space, but or in the multifamily space, maybe you're looking at scale, um, business owners, all of that. Like you're really creating an environment, hopefully of opportunity
Mhm.
for all the people that you're kind of connected with through that endeavor, uh, and so I think looking at it from that direction can change a lot of maybe people's perspective on it, because sometimes we have, I guess, as a landlord, you can sometimes be vilified and looked at as, oh, you're just in this for the money, but we really are providing homes for people, and I think but at the end of the day, it's also a business, so you've got to put all of that together in order to make it work. So, you said all your properties are in Texas?
They are, yes.
Okay. And San Antonio, or kind of spread throughout?
They're spread throughout San Antonio, Houston, and Austin. We've got one in Austin and kind of a pretty even split between San Antonio and Houston.
Mhm.
We started in San Antonio, as I mentioned. We built a base of properties here before we moved to the Houston market. But we found that the two markets behave very similarly
Mhm.
in that over 50% of the households rent. And so if you have, let's say, San Antonio with a, 2.6 million population, and then Houston is 8 million, if
Yeah.
50% of those households are renting, there's a lot of not only opportunity, but there's a lot of units that help provide housing to people. And so that was important.
Yeah. Yeah. I used to, we lived in Houston for a few years and had some really good friends in Austin. And you touched on this, I think, but I was struck by some of it's all Texas, but it's a huge state, and they're very different cities. Houston, Austin, San Antonio, and Dallas. They're all kind of a very different market, and yeah, probably Houston and San Antonio might be the most alike, but there are
Mhm.
nuances to each, and an interesting dynamic. And so probably, uh, I, thinking back on it, we've had a number of people on the show that do invest in Texas, but I can't think of anyone who invests in all the city. They're either
Mhm.
DFW focused or Houston and San. There's kind of a breakdown, and I think there's a reason for that. Houston has its own set of interesting no state income tax, but pretty substantial property taxes. So there's different. Just it's a different beast. So it is
Yes.
but also like tremendous growth, particularly in those metros. So I think it's a great market overall. What do our investing landscape, the real estate landscape, has changed, I think, fairly substantially throughout the last, say we can start with 2020, because the pandemic was a pretty good marker there. I mean, what have you seen, kind of in the way that you've operated, the way that you've worked with investors over these last, 3 to 5 years?
Sure. Yeah. We'll start with the pandemic because that was a significant event, something that, across the US, none of us had seen,
Mhm.
widespread shutdowns of businesses, et cetera, which impact the employees that work at those businesses. So when the pandemic started, it started with, okay, everything shuts down. And then they said, well, certain businesses are essential, so they can stay open. Well, we were, deemed an essential business because of the services we provide so many people. So we stayed open. We never closed. Now, we did go in and train our teams. How do you safely take care of yourself and take care of the residents?
Right.
So we were probably some of the first with the acrylic shields at the desks, with, our actually the president of our management company personally went and trained folks on, if we're going to go into somebody's unit, maybe we ask them to leave for a couple of hours and go take care of their errands while we're in there. And the personal protection equipment was important. So we never shut down. And so we also did things like the government provided assistance to individuals that had lost their job. And so the communication with the residents was just critical. So, but the assistance that was provided, you had to fill out paperwork, right? And so some residents were like, well, I don't know where to begin. So we literally would fill them out for them and deliver them to their doorstep. Here's the information filled in. You need to just fill in your personal information, return it to us, or let us know. We'll pick it up and we'll send it in for you. So, because of that, we were able to help a lot of our residents get the assistance they needed at the time. And so, but we also heard from our team, there are people that are paying their rent. They're not sure how they're going to feed their family. So my husband and I took $10,000. We went and bought a bunch of groceries, the things that are, important for families. And our teams bagged them up and they delivered them. They knew who needed them. And so they delivered them to the residents. And so it's these activities, staying in contact with the resident, communicating with them, helping where we could help, allowed us to get a 10% increase in revenue during the pandemic. When we first started, we're like, oh gosh, what's going to happen? Will people pay their rent? But what we realized, and it became even clearer, was people prioritize two things: a roof over their head and food for their family or for themselves. So they might not go to the movies, they might not buy a car, they might not pay for some of their credit card debt, but they prioritized housing. And so that was another big indicator to us that the business we're in is a very important business.
Yeah.
So that was 2020. We actually bought a property in 2020 in Houston at a great opportunity because no one was buying, no one was selling. So it was great. And then we continued to be active over that. The next, call it 21, was kind of the high point in real estate in terms of pricing, selling, et cetera. We were able to exit one property at 374x at the time. So because people stayed in their units, and initially during COVID, rents were not raised, but then rents really caught up in 21, kind of the beginning of 22. So we saw the benefit of that. And then came the 11 rate hikes by the Fed in a very short period of time, which we have always had a balance of fixed rate loans where the rate is fixed, and then but floating rate loans, when interest rates dropped so low, became really the key, right? That was what was being done. That's where the debt for our new acquisitions was coming from.
Yeah.
So once the debt amount started to rise because of the rise in interest rates, then we really zoomed in more on cash flow, operations. I will say that operations, we have focused a ton, always have, but probably in even more detail over the last year and a half to 2 years on the operational side of our business. We are vertically integrated, which, if you hear those terms, it just means we own our own management company that manages our properties. Luckily, all of that was set up because even during COVID, they could pay online, they could do applications online. Everything was controlled, by us. And so what we've seen is that has been a huge piece of our ability to continue to operate our properties during the last, call it, year and a half to 2 years of what I call a critical time period. And so we are, my husband and I visit the properties on a quarterly basis. We have weekly meetings with our team, so we know exactly what's happening at our properties at all times. So the good thing today is that the fundamentals are still there. Texas had a lot of deliveries of new units that were constructed and delivered in 23, 24, 25.
Right.
All of that has been absorbed. Construction permits for multifamily are down, let's say, 80% in San Antonio. So there's not a lot of new deliveries coming into the future. So what we know is the demand is there. Texas has been number one in population growth across the U.S., continues to be millennials, Gen Z, that the folks that kind of meet that biggest percentage of our renter groups is growing and moving to Texas, because we are more affordable, in terms of rent, in terms of housing in general. And we have jobs. And so that has continued to drive folks to Texas and has created an environment where we strongly believe the next 2 to 3 years are going to be phenomenal, because rents will grow again. We're seeing rent growth today, but not at the level we saw, call it 4 or 5 years ago, right? So we're seeing that trend is coming back, but we had to manage through some things. We had to manage through an environment where all those new units were offering discounts, 1 to 2 months worth of rent, that we were in some cases competing with, in a lot of cases not, because we own Class B properties primarily. And that's kind of that middle road. What was being delivered were luxury or more A class, where rents were, call it 400 to 700 higher than our rents. So we still find that Class B space is great, um, because if people cannot afford those A class rents, they move down to B class properties. And
Sure.
so we're kind of that middle that is a catch all for what people are looking for in terms of affordability, yet nice units to live in.
Yeah. Yeah, that's a great summary. I think the kind of brings me to what I wanted to ask you about. You mentioned you are vertically integrated, have your own property management company. When did you do that right from the beginning? Kind of when did you start that, not side business, but I mean, it's obviously related, but a lot of people will use third party property management and maybe they get enough number of units. I've heard many different numbers thrown out there as to what the right number is, but I'd love to hear kind of your perspective on taking property management in house and kind of how that impacts your overall business model and maybe even what you think about that for investors, your investors.
Sure. So the first 4 properties that we bought primarily on our own with a small number of investors, friends, and family. So we managed those until we were advised by somebody to try third party. They said, you've got about 500 units. Why don't you, focus on growing the business and let somebody else focus on managing the properties? We tried that for about a year. It did allow us to grow. We hit about 1,000 units, which is the number we had been told is the right number to kind of launch your management
Yeah,
company. So we relaunched, brought the properties back in house, hired a bigger team, and that's the key. I think with starting your own company is you do want to have HR, you do want to have regional managers, you do want to have accounting, you want to have those elements that allow you to run it like a business. And so that size allowed us to hire a team to bring the properties all in house, and we've been managing them since. A couple of learnings from the third party phase for us. One is you don't have as much control. You are waiting 30 days to get the results of what happened the previous month from a third party company. They can't do it any other way, right? They have to wait till the month is over to show the results. But what we found is that we couldn't react to it fast enough. So if, let's say, occupancy declined by 1 or 2%, we couldn't react to what had already happened other than to look at and go, what are you doing about the future, right? And so that was important. The other one is on the financial end, the same thing. We couldn't see what was being spent on the properties, even though we set parameters, even though there was a budget. We couldn't see it until after it had happened. And um, I will say there are a lot of great third party companies. So do not take this in any other way other than this is what we experienced. So,
sure.
for example, one month we saw a $6,500 charge for new pool furniture for one of our properties. And we knew we had not received new pool furniture at that property. And part of it is my background, right? Being in banking, I would comb through the general ledger every month in extensive detail. So, and then I would spend a couple of hours generating an email about the questions that I had from the financials. So all of this to say, if you're using third party, just be very diligent in watching the numbers, because that $6,500 wasn't our expense. And so if I hadn't asked about it, we would have, bore that expense and didn't have anything to show it for
Right.
it, because we didn't get the furniture. So I would just say be very diligent. Be know on the asset management side what key indicators, performance indicators you're monitoring. Stay on top of those, because that's super, super important. And I think the biggest one for us was we share the vision with our team, as we take on a new property and on an ongoing basis 3 times a year. We bring all the teams together and we share our vision. We talk about how the resident is number one, closely followed by our investors. Our team knows. They know that our investors rely on their work, their good work, to deliver results. And on the same token, it's up to us as the leadership to create a great culture. Behind me, you see a top places to work. That's been 3 years in a row. The National Apartment Association gave us an award also for being a top employer. If you have happy employees, you will have happy tenants. So we spend a lot of time creating those relationships within our teams. And we tell our team members when they're hired and remind them at those, meetings that we have all hands on deck, that they are our culture ambassadors, not just within the company, but with our residents. The experience that people feel from them will impact the company in a great way. And so, helping them be culture ambassador, asking them to be culture ambassadors for us is key. My husband and I are two people out of just under 200. So they're the ones that are really carrying the torch every day and help produce the results that we see on a monthly basis.
Yeah, no, I love it. I love that kind of breakdown. And I think, I mean, yes, there are property management is a hard business, and I think that
Mhm.
it is an interesting. There's a very interesting accountability dynamic that plays out because, yeah, they're sent. The goal is that, the property manager is managing everything. They're managing expenses, but at the same time, it's not their money, and so they have there's property management fees, and so they it's like being it's interesting to me because you get to pay yourself first,
Mhm.
kind of
Yeah.
regardless of performance. And I think so there's to me there's a big upside to bringing it in house. If I don't know what the right number of units is. I've also heard 1,000, but I think that yeah, at some point it definitely makes sense to kind of have that be your own. You're driving that ship yourself. So I appreciate your perspective on that very much.
Yeah, it's been key to us. Like I said, you can do it the other way. You just really have to become an expert on the asset management side, which just means managing the manager. And
Yep.
a lot of big groups have done it. A lot of smaller groups have done it. Your focus just switches, right? We also have asset management in house, but you then are the one watching those numbers, that you can't see every day, but you'll see at the end of the month.
Yeah. Yeah. Exactly. It's a more real time assessment of what's happening, and it is. It's the the real estate world, especially in apartments, it's a month by month picture. Basically, every single month, you're sort of restarting and figuring out, okay, are we headed in the right direction? So you have to make tweaks every month based on how performance is going. So, well, Arlene, let me switch gears here. I want to make sure I get to ask you some of the questions I ask every guest. And the first one, the name of the show is Know Your Why, and so you've talked a lot about impact and you kind of the importance of that to you. And so I wanted to, I guess, ask the question directly: what is your why, and give you a chance to kind of expand on some of the things you've already touched on for sure.
Sure. Well, I think, our why, at the top of that list is family. For us, it was, we didn't obligate the kids to be part of this business. We just exposed them to it.
Yeah.
And so for us, it's legacy. It is, uh, we're building something and you want it to pass along to another generation if it makes sense. And so the kids understanding our values was super, super important. And I think that's our probably our primary why, but not too far from that is our team. The ability to develop opportunities for our team to do well. That is super huge for us, because they do touch the residents every day. And but when the residents are happy, then you have your investors. And you mentioned something earlier, but it is an incredible feeling when an investor tells you, you didn't realize it, but the money that we made from the investment helped me send my child to college.
Yeah.
That there's no replacement for that in terms of a thank you, because not only did you impact that investor, you impacted that child of theirs that was able to get their education. So I think that to me is super, super important. And then empowering families, it's about empowerment for us. Not only our resident families, but our team families and our investor families and our own family. Nobody teaches kids about investing. It just isn't taught in school. I mean, nothing really financial is taught in school. So I encourage parents. They say, I read an article that to start as early as the age of 9, which initially I thought, wow, that's kind of young. But they said, no, if you empower them with knowledge at their level, right? We're not going to share cap rates and, some of that more complicated
They won't
metrics,
be underwriting at 9, but yes,
No,
yeah, I get what you're
no.
saying.
But if they understand, the value of hard work and money and how money fits into not just gathering it, but doing good with it. I think you will teach them some lessons that they will carry throughout their lives. I think that's important. We have an opportunity to impact our kids, and then they're going to impact others as they get out into society and they become, young adults.
Yeah, yeah, I couldn't agree more. I mean, the family aspect of it is very important to me, and it does extend beyond my own family. It's the families of investors, the family of our employees, the vendor. I mean, really, it is. If you start to think about it, I mean, it's quite an exponential impact that you can have. And teaching, I mean, you said nobody teaches kids. I mean, realistically, many adults don't know about
I agree.
financial literacy and things like that. So I think that's where podcasts, your radio show, just interacting with our investors, that the feedback of sending a child to college, like that's just that stuff feels good. It feels good to send out distributions. Like it's just kind of you are making a difference in people's lives, and it matters. It's work that matters. So I that it really resonates with me. Kind of the way you put it, and specifically saying empowerment, which I think the family theme has, it's a big part of when I ask people, what is your why? Family often comes up, but the empowerment piece of it maybe hasn't been articulated as much or as well. And I just think that's a really a perfect word to kind of put on what really we're trying to achieve here, what the goal is with having impact on that many people. So I love that. Thanks
I
for
agree. And I think one of the beautiful things about the younger generations is they are more about impact.
Mhm.
So they are wanting to make sure that the planet, is in good shape and lasts for a long time, and
Yeah.
that there are, those opportunities. So I think it's in keeping, and we're finding more and more that investors love the impact part of their investment.
Mhm. Yeah.
It's not just numbers in, numbers out. It is numbers in, you touch a life and you get numbers out. And so I think it's been, I think a big part of why we love this business. It is a lot of work. Running your own management company is a ton of work, and we didn't start it as a money making venture. Breaking even is good, but
Yeah.
but it is about controlling and being able to do what you know is right.
Yeah, yeah, completely agree. It's a lot of the focus gets put on the money that can be made, and it it's like you mentioned that first one was a 300 plus percent growth, and that's phenomenal, and that is real, that can happen, but at the end of the day, it's not every deal will do that, and so if you're looking at it from a global perspective of impact, empowerment, all of that, like it just makes uh, it makes so much sense, and it helps, I think, maybe equilibrate those highs and lows, in terms of whether it's deal performance or just the hard work that goes with it. So I think it really really a great point. Um, Arlene, when people hear this and they want to connect with you, what's the best way for them to reach out?
They can find us at reepequity.com. That's REEP equity.com. There is a place there that you can mark invest now. You don't have to invest the minute you click it. It's more for us to be able to connect with you. And then we will set up a phone call to get to know you, find out what your questions might be, what your goals are, and just start building a relationship, getting to know someone. Before anything happens or any transaction, it's we want to know who you are. And then on our website we also have some great educational material, blogs, podcasts, everything from multifamily 101 to the basics of investing in multifamily. Again, our goal has always been to educate and empower our investors to be the best they can be.
Yeah, amazing. We'll get that in the show notes so people can find you. And I would just like to say thank you again so much for being on the show today. I've enjoyed the conversation a ton. I think I really love the message that you have, and kind of what you're doing for the families that are associated with your work. So thank you so much for being here and sharing everything that you did.
Thank you, Jason, and thank you for hosting a podcast. It is a lot of work too, and you're doing it so that you can help others and share messages. So I appreciate you doing that on behalf of all of us.
I appreciate the kind words. And with that, folks listening, please like, rate, and review the show so we can continue to get more great guests like Arlene. Make sure you connect, and as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?